first want to touch on stainless, which has been a bit of a mess over the last month. You can see that very clearly here within this 1-year nickel chart. And again, I got to do a little bit of education or a little bit of story time on what happened within the nickel market over the last month or so. As we understand it, and some of this is a little bit of hearsay, but it's for the most part looking like it's true. So I'm going to kind of tell the story, and then we can obviously take Q&A at the end on any deeper dive questions one might have. As we understand it, one trader, which is arguably Glencore, the world's biggest commodity trader, they took a long position in nickel. Whether they were doing that for speculative reasons or for hedging reasons, we don't know, but they had a very large position that represented about 50 to 70% of the physical inventories that existed on the London Metal Exchange. On the other side of the trade, we understand Tsingshan, which this has gotten a lot of press. Tsingshan, which is the world's biggest stainless steel maker, they had a short position, meaning they were hedging themselves or protecting the downside risk of nickel prices dropping. They had a short position on about 200,000 metric tons, and the pricing was somewhere around $10 a pound. When the market starts to rally and you have a large short position, and again, I don't want to insult anybody's intelligence, but giving a little bit of color on what's happening, you can get what's called a short squeeze, where if you're short and the market runs up, your risk is basically infinite because the price of nickel can go as high as it wants. You're not bound by the price of zero the way you would be in the opposite scenario. So it can cause some panic. And if you've got 200,000 tons of nickel short, which is worth a lot of money, that liability on those financial positions can get very large very quickly. And about 3.5 weeks ago, the price of nickel jumped 250% to about $50 a pound. Now you're probably looking at this chart saying, wait, if it went to $50 a pound, why am I not seeing this on the chart? Well, the reason why you're not seeing it on the chart is because behind the scenes, as the market was ripping to $50 a pound roughly, that liability position for one company got as large as $15 billion. It could have been, that liability position may have perhaps been larger than the company Tsingshan itself. So long story short, there was perhaps no way for Tsingshan or for their banks to cover that kind of liability position. So what the London Metal Exchange did is they said, we're going to stop trading. They halted trading, and they actually did something that's fairly unprecedented, which is they canceled about 8 hours worth of trades, which were all the trades that were taking place between $22 a pound and $50 a pound. And what they did was they artificially set the price down at $22 per pound. And I can tell you that there were a lot of traders who were extremely upset about this because they were long this metal, and they believed that they were owed millions and millions of dollars by either the exchange or from their bank. And so fast forward to where we are today, what's transpired? Well, you've got the London Metal Exchange that's put trading limits on each side of the market. So you've got a 15% gain or loss limit on how much the exchange can now go. And that's not just true in the case of nickel. That's true in the case of all the other base metals on the exchange as well. And as we fast forward today, you can see that when the market reopened, the exchange went limit down, limit down, limit down, until we got around $12.5 per pound. Since then, the market's been extremely choppy. There's been a general lack of liquidity, which just means there's been a lack of trading interest in the market. And so that really kind of gives an idea of what we're seeing within this space. And I've got a little more here in just a couple of slides. This is the exchange inventory on the London Metal Exchange. So this is actually the volume in metric tons that exists within the warehouse system of the London Metal Exchange. As I mentioned at the onset, there are about 74,000 metric tons on the exchange. Half of that roughly was cornered by one counterparty. So in essence, you basically had somebody who kind of gamed or controlled the system on the long side of the equation. That part is not fully unprecedented. This actually did happen back in the 1980s in the tin market. A Japanese trading company called Sumitomo actually cornered the tin market. A short squeeze occurred then. And the London Metal Exchange is actually forced to close the exchange on tin trading for about 5 years. So obviously we're not seeing the nickel market closed for 5 years. We're seeing it more like 2 or 3 weeks. But I think the cancellation of the trades really irked some people in the marketplace, because that's a fairly unprecedented thing. And then lastly, as we look at, I mentioned the fact that there's less liquidity in nickel now, and that's causing a lot of this extreme volatility in the nickel space. This chart gives you an idea of that. It's called open interest, which basically means the number of open and active transactions that exist on the LME nickel contract. You can see that as soon as that squeeze occurred, the open interest in the contract fell off like a rock. Now, what is that represented? I think it's probably one of two things, if not both. One, that's probably representative of Tsingshan getting out of their short positions, actually liquidating their trades by buying back the short positions that they had on the books. That then basically takes those volumes off from an open interest standpoint. And then I think secondarily, as I mentioned, you've got a lot of very angry traders who were long nickel and believed that they were owed millions and millions of dollars. Some of those traders are now saying, I'm never trading in the nickel market. I'm never trading on the LME ever again. And they're basically taking their ball and going to different markets. So the LME has certainly lost some credibility in this situation. And I think the jury is still out on how we progress in this situation. As it relates to stainless, because I know many of you are actually buyers of stainless, you're not buyers of nickel. So we have to kind of address the elephant in the room, which is what happens to stainless pricing. Well, each mill is kind of approaching it in a different way. North American Stainless, for instance, I'll pull up the nickel chart again. They basically ignored all of the short squeeze prices. So any of the trades that took place post that big short squeeze, they pulled them out of their calculation, and they basically artificially set the price of the surcharge for April shipments down at $12.60. Now, going forward, at least for now, it's my understanding that they are going to go back to the exchange mechanism and honor the LME pricing, which unfortunately, if we use the market pricing today, which is roughly 1530, that would increase 304 prices, 316 prices by roughly 15 to 17% just from the nickel move itself. So as long as the mills continue to adhere to the LME nickel market and we continue to see it price around where it is today, that's likely going to mean further and higher surcharges in the coming months. As we think about other possibilities that could happen, because I think we have a disconnect between what the London Metal Exchange is and what it's intending, or what it was intended to do for the marketplace. Because as we think about it, the London Metal Exchange and these warehouse inventories that I'm showing here on this chart, those represent refined nickel. So this is like 99.9% pure nickel content. As many of you on the call may know, the nickel that goes into stainless steel, the nickel that goes into lithium-ion batteries for electric vehicle production, it doesn't have to be refined nickel. So in a lot of ways, you have this instance where nickel is not nickel is not nickel. The nickel that is accepted on the exchange, which is actually mandated to be a certain purity, is not the same necessarily kind of nickel that goes into the production of the physical goods that move around the world. So you've got this situation where one little situation, which is 74,000 metric tons of refined nickel, is all of a sudden having knock-on effects to the price of buying an electric vehicle, the price of buying stainless steel. And I don't think that was ever the intent, to have that kind of disconnect. So there's a chance that the LME nickel contract goes away. And I don't necessarily think that's going to happen in the next month or two, but it's certainly a risk. And because you can make the argument that perhaps the North American stainless mills should be pricing off of stainless scrap, because that's how they produce it. But we'll have to wait and see. So I don't mean to be too hyperbolic about it, but the nickel market and as it relates to the stainless market, is a bit of a mess right now. For all intents and purposes, it's kind of broken as we sit here today. And there are a lot of traders and participants within the space who are, like I said, taking their ball and going home and leaving the market behind.
And Nick, you brought up, I think a few questions came up during that segment, and you kind of ran into all the answers. One of them being any thoughts on using stainless scrap instead of nickel to calculate the surcharge, which you just answered, and then about LME maybe shifting to a more neutral exchange. But so yeah, definitely a hot topic. And I should mention this all happened, I think, the day after last month's Cup Joe, right? Yeah. So like the information we put out, it was the next day, just kind of blew up.
Yeah, I mean, I do not envy the CEO of the London Metal Exchange right now. I would guess he has not slept a whole lot in the last couple of weeks. But a lot of money is on the line, a lot of credibility is on the line. But yeah, all those questions are very valid, which, the LME, as I mentioned, there are certified brands. And when I said brands, basically makers of the nickel, certain regions and obviously certain purity that is accepted on the exchange. And that's just not a good representation of the physical market anymore. Our CEO actually last week made a funny comment where he said, basically, Tsingshan, the stuff they were shorting, or in other words, the stuff that they used to produce stainless steel, it was basically like Tsingshan had 1 million tons of hamburger, but everybody at the party wanted steak. They're similar. They are similar, but if the exchange doesn't accept the other one, then there's no real fungibility between the two types of products.
So Nick, I'm sorry, I don't mean to park you there for a second, but where do you see stainless prices then headed maybe in the next 6 to 12 months?
I mean, if we get back to fundamentals and the markets can trade and operate in a normal fashion, I tend to be of the opinion that nickel prices will revert back down into a more normalized range, which I call normalized range, looking at this chart, somewhere in, let's call it around $12 a pound, 10 to $12 a pound, I think would make fundamental sense to me, because a lot of nickel miners around the world can make plenty of money at those types of prices. It's actually the reason why Tsingshan, who is a nickel miner themselves, it's why they had short positions on in the first place, because they were hedging their forecasted production, and then they knew they could make money at those types of price levels. So I think if you ignored the gamesmanship and the trading dynamics of what's taken place over the last month, I think that would be a natural place for us to go, which would actually feed through to a lower surcharge. So I'm only talking about the surcharge. I'm not talking about base prices from the stainless mills. But unfortunately, we have a situation right now where I think there's less liquidity in the markets, less volume taking place. So getting good price discovery in the market is certainly more difficult right now. And my analyst and I actually got a note just a little bit ago that said some of the banks are even revisiting whether or not they even want to participate in offering hedges and trading in the nickel market in general, which that's not going to help liquidity either. So again, it just comes back to this theme of it's a bit of a mess right now. But I don't think behind the scenes, if I'm a stainless mill, yeah, prices going up is a good thing for a bit, but prices going up too far and in a very erratic fashion, again, coming back to this demand destruction theme, you could see some issues with that. So I don't think the stainless mills really want a ton of, volatile pricing, particularly to the upside, because that could end up leading to some demand destruction within the stainless